I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the Vinny G Markets channel, brought to you by Vinny G Money. So let's start this video off by going over what we were looking at in our last video. While we were playing chess, we were trying to configure what was going to happen with the Russia-Ukraine situation and the Federal Reserve's decision to raise interest rates. So we took the highest probability, and that is what came out. The Russia-Ukraine situation, it stayed within Russia and Ukraine, and the Federal Reserve, they took the non-aggressive route and only raised interest rates by 0.25% and not 0.5%, and it wasn't enough just getting that right. We had to figure out how the markets were going to react to that. A lot of people were thinking that the markets were going to tank due to any interest rate raise, but that wasn't the case. Like we said on this channel, the Federal Reserve, they did raise rates by 0.25%, but what happened? So let's take a look. The S&P 500, and these are all monthly time frames, but we could see since our last video, March 7th, the markets have actually been up more than the month, but the S&P 500 for the month is up almost 4%. The Dow Jones for the month is up almost 3%, and the Nasdaq for the month is up almost a little over 3%. So like we already stated, the markets, they like both those scenarios playing out with the Russia-Ukraine and Federal Reserve situations, just as we suspected on the Vinny G Markets channel. But let's take a look at our three indicators. We have the US 10-year Treasury. Now this is something we're going to have to keep an eye on. In our last video, we were talking about how low it got at around 1.7, as you see on this chart. With the Federal Reserve raising the interest rates, it did cause this to move up a lot. So the US 10-year Treasury right now is currently at 2.48%. This is higher than we're used to seeing, but we'll get back into that. The US dollar index, it actually went down a little bit since our last video. We're currently sitting at 98.81. Nothing really concerning here. And crude oil, we did expect crude oil to pull back a little bit since our last video. It was at like 120 and it reached like, I think 130 at some point, but it did cool off to where it dipped below $100. But like we said, even though there was a short-term pullback, crude oil, it's not going to get cheaper. Energy is not getting cheaper for anybody. So any type of pullback, this is just going to continue to go up. But let's go back to the US 10-year Treasury, which is currently sitting at 2.48%, and some might see this as very high. And if you've been following the Vinny G Markets channel, you know this is what we follow. This is going to indicate when the big market crash is going to happen, a spike in the US 10-year Treasury. I personally don't see this as a spike in the US 10-year Treasury, and another reason why I'm not concerned about this is the US 10-year Treasury, it initially rose after the Federal Reserve made the announcement they were going to raise their interest rate by 0.25%. So that's something natural that you were going to see in the US 10-year Treasury. As they raise their rates, so is the US 10-year Treasury is going to rise. And like we also stated in our video, how the markets were going to react, and also this interest rate is based on what the Fed says after this. You know, they send out their creatures, including Jay Powell himself, and they confuse the market with hypotheticals and predictions on what they're going to do with the interest rates. And a report shortly after came out that Jerome Powell is saying that he could raise interest rates more aggressively because he needs to fight inflation. And the reason why I'm not worried about this is because I know that makes no sense. The Federal Reserve, they're not going to be able to raise interest rates enough to fight inflation. They have inflation currently set at 8%. We know that's a lie. It's much higher. But even if we want to go by the 8%, these nudges in the Federal Reserve interest rate at 0.25, even if it's a 0.5, they're not going to come close to the 8% that they need to fight inflation. And also, that's only one part of the puzzle. What didn't they do? They haven't tapered yet. That's more of what we need to focus on. If the Federal Reserve started tapering already, I would be more concerned about that than the actual interest rate rise. So as long as the Federal Reserve, they're continuing their asset bond buying purchases, nothing's going to change in this market. It's going to still keep going up. We might have a pullback here because the interest rates did rise and so did the market. So that's a little bit of an inversion. I would expect some type of pullback sometime soon if the interest rates stay at this level. But as long as there's no taper, and we'll pull this up, you could see on the Federal Reserve balance sheet, it's done nothing but go up even since the November taper announcement, which was a complete joke. The Federal Reserve, they haven't slowed down their bond buying purchases, which they said they would. And you could go to our prior videos for this, and I'll even pull this article up. This is back in August. The Federal Reserve stated that they were going to start raising interest rates once the tapering process has been completed. That hasn't happened. They started raising interest rates without stopping the tapering process, which shows that they don't care about inflation. They want inflation to run hot so they could wipe out the middle class of the United States. And we're going to go over the blueprint on how we're going to protect ourselves against this with our portfolios. Again, I'm not a financial advisor. This is not financial advice. No matter what I state, you still got to do your own research. I could definitely be wrong with all this, but we're just stating our opinions on here. But before we go over the blueprint or getting over the blueprint on what we need to do, we're first going to pull up this article. Because the U.S. Treasuries had such a bad week, U.S. Treasuries plagued by illiquidity. And if you've been following the Vinny G Markets channel, you know we watch these interest rates like a hawk, because we know it's going to be issues in the debt market that causes a stock market crash. You can't look at the stock market to try to find out when the market is going to have that overall gigantic crash. You have to look at the debt market. It's the implosion in the debt market that's going to cause the bottoming out of the stock market. So let's go back to 2008. 2008 is when we had the subprime mortgage crisis. That was our first issue in the debt system, and that was just subject to the United States. Even though it was just the United States, that issue itself almost took down the global financial system. And because there was such a big issue, it's when the Federal Reserve had to start their quantitative easing program. But now fast forward to 2020, we now have a global sovereign debt issue where nations around the world are failing unless they're able to access cheap, easy money. So what's happening is the U.S. Treasuries, they're still considered the most liquid asset in the world. But when interest rates start rising, it turns into a game of hot potato where nobody wants to hold these U.S. 10-year treasuries. Because when interest rates are rising, the prices actually fall. At one point, you had different entities such as corporations, hedge funds, insurance companies, pension funds that wanted to get into these US 10-year treasuries because it was such a safe asset and it actually returned a decent yield back in the day. And they didn't care so much about these interest rates if they did rise, because they would just hold on to these assets and get paid out the maturity, which was still a great return for a safe asset. And former Fed President Alan Greenspan, he explains it the best on how safe the U.S. Treasury investment is. He stated that the U.S. government has 0% chance of default. It could always pay any debts or any bills it has because the United States have the printing press to do it. But he also said he cannot guarantee the purchasing power of that money, and that's what we're seeing right now. If you take a look at this chart, we've pulled this up before. If you're holding the US dollar, your purchasing power has just been dwindling every year, no matter how far back you go. But it's that printing press that Alan Greenspan touches upon that gives that 0% doubt that the government will always be able to make their payments. But present day, and not present day, what's just been happening over time is the Federal Reserve has been printing so much money, and the rates have just been dropping so low, you can't get any decent return. Like, let's say hypothetically with $1 million, and with $1 million back in the 80s, you were able to earn $100,000 for the year just by parking that money with the US government, which according to Alan Greenspan was a risk-free investment. So a risk-free investment earning you $100,000 off $1 million is great. You could buy houses, cars, go on vacation with that money. But now, present day, you park $1 million with the US government, even though it is essentially risk-free, all you're really earning on that money is around $15,000 to $20,000. Now, what happens with that is because you're only earning that $15,000 to $20,000, money velocity drops. So money's not moving around in the economy. So even though we have all this new money printed, money velocity present day is at all-time lows, which is showing the real concern of this economy, that nothing is good about it. So these entities such as the pension funds and insurance companies, they were looking for a good, safe return on their money, which they were able to get with the US Treasuries. But since those US Treasury yields have started dropping, these entities needed to look elsewhere for a decent return. So where they start going, they started going to corporate bonds, emerging markets, junk bonds, any place that was just giving a higher interest rate so they could get a better yield on their money. And the first sign of this system cracking was in 2008 with the subprime mortgage crisis, because these entities, they were also invested in these subprime mortgages, getting good rates of return, thinking they were safe investments, but obviously they weren't, and everything blew up in their face, but got bailed out by the Federal Reserve because in 2008 they started their first but not last quantitative easing program, which put a band-aid over everything for the time being. But let's fast forward to 2019 when we were flashing red signs about a recession about to occur, with all the quantitative easing slowing down and showing to be non-effective at this point. We had inverted yield curves, which is signs of an unhealthy debt market. GDP growth was slowing, corporate profits were plummeting, manufacturing growth was declining, freight shipments were slowing down, copper was falling, gold was rising, the monthly global economic policy uncertainty index was rising, and we had business spending all declining at the same time in 2019. But the Federal Reserve, they had something in their back pocket to avoid a recession. It's Section 13.3 of the Federal Reserve Act. It's a singular power of the Federal Reserve to permit Federal Reserve banks to provide liquidity directly to non-bank commercial entities. This power is only available in times of crisis when the Federal Reserve, by a vote of 5 governors, find that exigent and unusual circumstances exist. In recent practice, this authority has been invoked in times of market disruption, such as during the financial crisis of 2008 to 2010, as benefits the title assigned to this authority by the Federal Reserve, emergency credit for others. So because this is the Vinny G Markets channel and we only speak the truth over here, the truth is the whole 2020 situation, it was just a cover-up for the eventual recession that was about to hit the United States. The 2020 situation, it provided those extenuating crisis circumstances where the Federal Reserve was able to give out all this stimulus money to cover up that recession. They told people to go home, not to work. There was supply chain breakdowns. They only told essential companies and workers they were able to operate, and this caused the government to send out a bunch of free printed money to the people, which those people therefore wiped out all the inventory while supply chain issues were going on top of it. So therefore, we had the deepest and fastest recession in the United States history, which was covered up by this flood of money. So it ain't hard to tell that without the 2020 crisis taking place, we would have been in some serious economic pain, because the Federal Reserve, they wouldn't have had the excuse to have the unusual circumstances to allow all these special purpose vehicles to be built. Now, what special purpose vehicles were built? We could take a look at this list here. How Section 13.3 been employed during the C-word crisis. The Federal Reserve, with approval of the Secretary, invoked Section 13.3 to create numerous facilities to combat economic dislocation caused by the C-word pandemic. These facilities include, I'm not going to list them all, there's about 8 of them. Some of them were just revised from 2008, but you see, this is what saved the actual real recession from happening. And we're only going over all this right now to show that we're at a crossroad of 2 different ways we could go. The Federal Reserve, they could actually start cutting back on the bond purchases, but if you see, there is a wild card. It's the Russia-Ukraine situation. We already have the European central banks considering extending its money printing program beyond the summer if the Eurozone economy fell into a deep recession because of the conflict in Ukraine. So you see that the war is already being used as an excuse to continue the money printing. All these central banks, they're all part of the BIS, so the Federal Reserve could easily follow suit with the European Central Bank, where if they see the war is the reason why the economy is starting to slump, they could continue on with their money printing even though they haven't even stopped in the first place. So as long as the Federal Reserve continues to buy the US Treasury bonds, that's going to put a band-aid over the issue we spoke about of everybody playing hot potato with the US Treasury, of nobody wanting to hold it. If the Federal Reserve continues to buy them, it's going to solve that problem, and it's going to keep the debt market stable. And as long as that debt market is stable, the stock market, it might pull back here and there, especially if this war expands. But as long as the Federal Reserve is keeping that debt market stable, especially if it uses the war as an excuse, we're not going to see that big market crash that everybody is speaking about. So we're going to continue to monitor that US 10-year Treasury. If it continues to rise quickly, that's going to draw the red flag. It's going to rise. That's just inevitable. We have to see how fast it rises. So it's at almost 2.5%. We'll see how quickly it takes for it to get to 3%. If it's quick, then that would be a red flag. But we're going to monitor that. And the most important thing we're also going to monitor is that Federal Reserve balance sheet, because we're going to see if they actually stop tapering, that would indicate an even bigger red flag. But me personally, I doubt that's going to happen because the Russia-Ukraine situation is such a wild card and how it's playing out. Let me start with this. We'll pull this article up. The US dollar's global standing as the top reserve currency has lost ground to China's yuan and others, says IMF. IMF is the International Monetary Fund. They're a very big deal. We've been over them before. The IMF says the dollar has lost ground in its share of international currency reserves. The dollar's dominance has been dented due to the central banks looking to diversify their holdings. China has pushed for greater adoption of the yuan, recently held talks with Saudi Arabia for a yuan-based oil deal. So going back to the Russia-Ukraine situation, I think we all know by now that Ukraine, they're rich in natural resources, and Russia, they hold all this oil that Europe is dependent on. So with them having all this oil and now trying to take Ukraine over with all these natural resources, they were already making demands that unfriendly countries must pay in rubles in order to get these natural resources. So I could already tell that this is going to spark a currency war. So combine this with the US dollar already losing ground to China's yuan, the US dollar, it's gonna fall. Add digital currencies to all this. All these countries now, they're gonna have central bank digital currencies connected to the rise of China. The digital yuan, it's gonna be backed by digital SDR. We went over this in the last video with China's Belt and Road Initiative. So this is gonna spark a currency war where the United States is gonna be so far behind. A currency war is gonna be needed to sell the people of the United States that a digital currency is necessary. Now, once you have currency wars, this is gonna lead to real wars. Now, once you have real wars, that gives the excuse for central banks to print money because these countries are going to have to go to their central banks to buy weapons. So in 2008, you had the subprime mortgage crisis, enabled the Federal Reserve to enact their quantitative easing program. The 2020 crisis, that enabled the Federal Reserve to reenact that Federal Reserve Act 13.3 and create all those money printing programs. So going forward, it's to my belief that the currency wars that's going to lead to real wars. That's going to enable those unusual crises for the Federal Reserve to continue to interfere and print money. And because the Federal Reserve will then not be tapering, it's going to solve that issue where you don't have to play hot potato with these US 10-year treasuries. And as long as that's happening, inflation is going to get much worse. We've seen nothing with inflation yet because you need to understand that the NWO, they need astronomical inflation in order for not only the people to accept digital currencies, but to make them want digital currencies. People are going to be begging for digital currency because that's going to be how they airdrop free money to people. But once you start airdropping this free money, it comes with a price. That's when you're really going to start seeing socialism coming to the United States. The US, they're going to have to follow China as their blueprint because China, they're leading us into this digital currency world. Because this free money, it's eventually going to turn into programmable money, and that programmable money is going to tell people where and when they could spend this money. It's going to be money with time limits where they're going to say you must spend this money in hypothetically a month or it's going to be gone. So people aren't going to be able to save money going forward. And along with that, all privacy is going to be out the window. We're going to have social credit. Blockchain is going to give the NWO that all-seeing eye. It's going to see all your transactions, and it's going to enable them to tax the globe as more emerging countries that aren't even on the banking system present day. This is going to give them that avenue to be able to get taxed by the NWO. And we're not just sitting here making things up on the Vinny G Markets channel. All this has been written about by Klaus Schwab, the executive chairman of the World Economic Forum. In 2016, he wrote a book, The Fourth Industrial Revolution. 2018, Shaping the Future of the Fourth Industrial Revolution. 2020, C-Word 19, The Great Reset. And this is all about using digital currencies and getting robots, drones, algorithm, and AI to take over the economy while humans get pushed into the metaverse, where in the metaverse, your mind is going to be easily manipulated. But the main agenda for pushing the masses into the metaverse is to take you further away from God or the Bible. They want to keep pushing you away from God to the point where you don't have a relationship with Him anymore. The people that run the world, the NWO, they're all devil worshippers, they're Satanists, and they want to turn you into a Satanist. But the trick that they put on people is that being a Satanist doesn't necessarily mean that you're a devil worshipper. Satanism is not about worshiping Satan, it's about worshiping yourself. Do what thou wilt, or do what you want is the motto. video, the devil doesn't care if you worship him, worship yourself, or whoever else. It's about you just not worshiping and serving God. So they want to continue to push you further away from God or the Bible. And the metaverse is going to do all this because just like social media, it's all about self-idolization. Because Facebook, Instagram, Twitter, TikTok, that's all it is. It's all about showing off, posting pictures of yourself, bragging without realizing it, and all types of self-worship. Social media and the metaverse, it could be used for other things, but predominantly this is what it's about. Getting you to worship yourself and take you further away from God or the Bible. And I mention this because beyond anything you could do with your money, the most important thing you could do is build your relationship up with God or the Bible. Start reading the Bible again and living your life based off the laws of the Bible. I'm not the most perfect example. I'm nowhere near perfect, and I'm a work in progress myself. But this is the most important thing you could do as we move forward in these hard times. The devil will play all types of tricks on you. God will never turn his back on you. But getting back to the financial side of things, I still like the blueprint that we have in beating this market. I still like energy and crude oil, the price of energy. It's not going down for anybody anytime soon. I like the big banks in an environment where we're raising interest rates a little bit but continuing to pump money. I see that benefit in big banks because we know we're about to head into currency wars, which will lead into real wars. Aerospace and defense contractors I still see doing well, and because inflation's not going to cool down, commodity ETFs or any stocks that have ties to commodities. And we might be a little late to the boat on this one, but agricultural ETFs, because right now we have an energy crisis, supply chain issues, shipping crises, and a fertilizer crisis. It's only a matter of time that this is going to turn into a food crisis where we have real deal food shortages, and these agricultural ETFs, they could begin to skyrocket. Do I have an exact timing on that? Definitely not, but I would start gaining exposure to those as well. So that's how we're going to position our portfolios in the near term. We still have our 3, 5, 10-year outlooks on our fourth industrial revolution stocks that we just continue to hold. We could continue to buy them as they take hits with the higher interest rates. But those, again, you can't expect to pay off until 3, 5, 10 years, along with cryptocurrencies. Cryptocurrencies, it's not a hedge against inflation. They need to be looked at as high growth stocks. But those, all you can do is take hits, buy on the way down, and just hold them with that 3, 5, 10-year outlook. And when it comes to the options market and selling options, you know, we're still trying to put together some type of system with some type of technical analysis that's going to keep us out of bad trades or just take advantage of the market volatility going forward. What I'm seeing so far, and again, this is a beta version, please don't hop on this, and again, you have to do your own research. ExxonMobil, I think, is looking very nice for a push forward higher. Again, we'll see what that does, and we're going to continue to work on that. So as you continue to see here on the Vinny G Markets channel, we're continuing to out hustle these markets. We got the blueprint. We attacking this market on every which angle possible. So if you want to continue to be part of that, come mess with your boy. If you like what you hear, Hulk smash that like button. And as always, I'll leave you off with this. The God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ is real, and may he bless you.
So having personal retirement accounts is another way of making a future retiree benefits more secure for their retirement. And also, do you believe that personal retirement accounts as a component to a system of solvency does help improve solvency? Because when you have a personal retirement account policy, it's accompanied with a benefit offset. With that feature in place, do you believe that personal retirement accounts can help us achieve solvency for the system and make those future retiree benefits more secure?
Well, I wouldn't say that the pay-as-you-go benefits are insecure in the sense that there's nothing to prevent the federal government from creating as much money as it wants and paying it to somebody. The question is, how do you set up a system which assures that the real assets are created which those benefits are employed to purchase? So it's not a question of security. It's a question of the structure of a financial system which assures that the real resources are created for retirement as distinct from the cash. The cash itself is nice to have, but it's got to be in the context of the real resources being created at the time those benefits are paid, so that you can purchase real resources with the benefits, which of course are cash.
Do you still believe that we should maintain the fundamental principles of Social Security as you did in 83?
I think we should maintain the principles of Social Security, but I think the existing structure is not working, and that until we can construct a system which creates the savings that are required to build the real assets so that the retirees have real goods and services, we don't have a system that's working. We have one that basically moves cash around, and we can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power. And this is why the issue ultimately has got to be resolved in terms of, do we have the material goods and services that people will need to consume, not whether or not we pass some hurdle with respect to how legal financing occurs, because the financing is a secondary issue, and it's the means to create the real wealth, not an end in itself.